An overview of personal loans in the U.S. Jessica N. Flagg, Simona M. Hannon. 2023. Abstract. Personal loans used for a variety of purposes, such as debt consolidation, medical bills, vacations, or the payment of a large ticket item, reached $356 billion or about 10% of non-revolving consumer credit at the end of 2022. Although depository institutions such as banks, thrifts, and credit unions dominate the personal loan market, finance companies, institutions that typically lend to non-prime consumers, hold nearly a fourth of these loans. This paper provides an overview of this nascent but relatively understudied sector of the United States credit market. 1. Introduction. In the aftermath of the global financial crisis, personal loans returned to prominence as a source of credit to consumers, partly highlighted by some of the technological advances in the consumer credit space characteristic of the past decade. While new financial technology, fintech, lenders entered the market and some even morphed into other types of institutions, traditional lenders continued to play an important role in providing personal loans to consumers. As the outstanding balances of these loans have recently started to accelerate, we aim to provide more information on this understudied sector, employing two relatively new data sources. As of the end of 2022, personal loans, also known as installment loans or other loans, used for a variety of purposes, such as debt consolidation, medical bills, vacations, or the payment of a large ticket item, reached $356 billion or about 10% of non-revolving credit. 1. From an institutional perspective, the sector is dominated by depository institutions, that is, banks, thrifts, and credit unions, and finance companies, consisting of personal loan companies and sales finance companies. 2. Finally, some payday lenders have recently started to offer installment loans. Our data allows us to highlight this new trend. Each lender type's distinct characteristics shape their underwriting practices, pricing, geographical concentration, and ultimately loan holdings. Although personal loans can have a variety of characteristics, they can be broadly categorized into secured, backed by collateral such as jewelry, savings accounts, or fine art, and unsecured loans. That said, they can also take the form of note loans or promissory notes, which are less formal agreements usually for small dollar amounts among parties with an existing lending relationship. 3. Alternatively, a consumer could also borrow from a finance company indirectly through an installment sales contract, an agreement whereby the loan is issued by a retailer and then subsequently purchased by a sales finance company. Personal loans can have either fixed or variable interest rates. In the remainder of this paper, we first review the regulatory environment for personal loans in the United States and then discuss select characteristics of the outstanding balances and the supply of personal loans, while providing some estimates for the sector based on relatively recent data sources. 2. Brief regulatory overview. The United States consumer credit regulatory environment is dynamic, multi-layered, and complex, in particular for non-bank issued personal loans, with states having full flexibility to adopt and repeal pieces of legislation. 4. The most important regulatory elements affecting the personal loan space are interest rate ceilings and banks' interest rate exportation ability. In addition, over the past decade, various developments, such as the Madden versus Midland funding ruling, the payday rule, or the adoption of caps for small loans, also put their marks on the sector. 5. First, historically, the personal loan sector in the United States has been regulated by the states through interest rate ceilings. State credit price ceiling laws generally included usury laws and a variety of special laws allowing higher rates than those allowed under usury laws for specific types of credit from certain classes of lenders. 6. Currently, 15 states have high or no interest rate ceilings. These are South Carolina, Georgia, Texas, Oklahoma, Louisiana, Tennessee, Missouri, Illinois, New Mexico, Kentucky, Alabama, Wisconsin, Indiana, Mississippi, and Idaho. In addition to state interest rate ceilings, credit unions are subject to their own 18% ceiling for traditional personal loans imposed by the National Credit Union Administration. More recently, after 2010, credit unions are able to make small dollar short-term loans, labeled payday alternative loans that can have interest rates of up to 28%. Second, in 1978, the U.S. Supreme Court in Marquette National Bank versus First Omaha Service Corporation ruled that national banks could charge interest rates permitted by the lending bank's home state regardless of the rate permitted by the borrower's state of residence. Until more recently, this significant court ruling had its greatest effect on the credit card market as it enabled credit card companies to expand their offerings geographically to consumers located across states with various interest rate ceilings. As a result of the Marquette ruling, credit card companies moved to states with high or no credit card rate ceilings, and the credit operations of many large retail stores and consumer finance companies were acquired by or otherwise became affiliated with national banks and their subsidiaries. For a while, payday lenders also used this rent-a-bank model in the 1990s and managed to circumvent restrictive state legislation by partnering with banks until the legislative loophole was closed for them. Stegman, 2007. Today, specialized finance companies and, especially, fintech lenders partner with banks for the same reason. Bhattacharya, 2021, Elihausen and Hannon, 2023. Third, other developments also put their mark on the personal loan sector in recent years, but to a smaller extent. Among them, Second Circuit's 2015 Madden v. Midland ruling, discussed at length by Denisevich and Ellard, 2018, restricted fintech bank partnership issued loans in New York and Connecticut by rendering loans with interest rates above the usury rates in those states null if sold to non-banks, a key feature of the fintech bank partnership model, highlighted by Elihausen and Hannon, 2023. The Consumer Financial Protection Bureau's transient ruling titled Payday, Vehicle Title, and Certain High-Cost Installment Loans, the Payday Rule, temporarily restricted the availability of expensive personal loans between the time it was proposed, in 2016, and its revocation, less than 3 years later. 7. Finally, more recently, Illinois and New Mexico adopted 36% caps on small loans. With the exceptions of the credit union 18% interest rate ceiling and of the payday rule, which acted like a stealth interest rate ceiling, Calamiris, 2001, and was applicable to high-cost loans across all states, the aforementioned regulatory restrictions apply locally and thus shape lenders' geographical concentration or credit supply. For example, finance companies restrict their lending to high or no consumer finance interest rate ceiling states, while fintech lenders partner with banks in order to circumvent low interest rate ceilings and disproportionately target riskier consumers living in low-rate states. Elihausen and Hannon, 2023. 3. Personal loans outstanding. In order to examine the personal loan outstanding universe, we use a newly released loan-level version of the Federal Reserve Bank of New York Quarterly Consumer Credit Panel, CCP, a database on consumers' credit use and payment performance drawn from anonymized Equifax Credit Bureau records. 8. The sample has coverage of personal loan, or account, holdings issued by finance companies and depository institutions, banks, thrifts, and credit unions, and reflects up to 4 accounts, or loans, per individual. Our sample contains industry code indicators that allow us to categorize the personal loan holdings by sector: finance companies, banks, thrifts, and credit unions. In addition, a new indicator has been recently added to allow the identification of personal loans issued by fintech lenders. Moreover, these indicators can be used to further differentiate the finance company holdings by finance company type: personal loan companies, sales finance companies, and a miscellaneous company category, thus offering a unique perspective into the usually opaque finance company universe. 9. Furthermore, our data include narrative codes that enable the grouping of holdings by product type: secured and unsecured. The latter also includes other loans, a category that primarily consists of note loans, lines or credit, and installment sales contracts, among others. Importantly, the narrative codes enable us to remove charge card accounts and closed accounts from our estimates, which is not possible using the individual level CCP data. This is paramount because the charge card balances are quite notable. 10. Although the CCP data do not contain interest rate information, the tradeline data set that we are using contains narrative codes indicating whether the interest rate on a certain loan is fixed. As personal loans tend to have lower incidence than other loan types, to ensure proper coverage, we use a 10% random sample from the total available 5% sample, covering the period between 2010, Q1 and 2022, Q4. As of the end of the fourth quarter of 2022, the Consumer Finance CCP loan level sample showed that more than 31 million individuals, or about 11% of the entire adult population covered by the CCP, had personal loans. 11. The personal loan sector reached $356 billion and consisted of 36.2 million accounts. The median personal loan account balance is $4,198 and the median monthly payment is $202. About 1/4 of loan balances are secured, close to 60% are fixed rate, and 40% are held by nonprime borrowers, those with Equifax risk scores lower than 720. Looking at outstanding balances, Table 1, Column I, we note that depository institutions dominate the personal loan market, holding of 77% of balances, or $273.6 billion, with banks and thrifts covering 49% of the market and credit unions covering 28%. The remainder market share, of 23% or $82.5 billion, belongs to finance companies. Although personal loan companies, those providing loans directly to consumers, dominate the finance company sector, our data allows us to highlight the presence of sales finance companies, those buying installment credit contracts at a discount from retailers or financing retail sales, and reveals the existence of growing number of miscellaneous finance company balances issued by lenders not traditionally classified as finance companies, but that offer personal loans. 12. Fintech lender balances currently stand at $49.9 billion, or 14% of the market. As fintech loans are typically offered in partnership with banks, depending on the moment in the life cycle of the transaction captured in the credit bureau data, fintech balances can be reported across the traditional sectors discussed previously. We will dedicate a subsequent note to fintech lending. Looking at the number of outstanding personal loan accounts, Table 1, Column 2, we note that depository institutions and finance companies hold about the same number of accounts, about 18 million. Taken together with the depository institutions' much larger balance holdings, this points to the larger balances on accounts held by depository institutions versus those held by finance companies and larger monthly payments. Table 1, Columns 5 and 6. 13. Indeed, the median account balance for depository institutions is $6,299 with a median monthly payment of $251, while, in contrast, the median account balance for a finance company account is $2,864 with a monthly payment of $163. Fintech lenders hold 7.7 million accounts, with a median account balance of $4,256 and a median monthly payment of $197. Next, when examining the personal loan sector through the borrower's credit risk profiles lens, Table 1, Column 3, we note the influence of institutional characteristics. In line with their known risk aversion, depository institutions primarily offer personal loans to higher credit score borrowers, while, in contrast, finance companies stay true to their position as a traditional source of credit for riskier borrowers. The median depository institution borrower risk score is 727, while the median borrower risk score for a finance company account holder is 626. Among depository institutions, banks are most risk-averse, evidenced by their borrowers having the highest median risk score, 741. In contrast, among finance companies, the largest credit providers, personal loan companies have the lowest median risk score, 610. As fintech lenders typically focus on near-prime and low-prime borrowers, the median borrower risk score is 670, somewhere in between that for finance company borrowers and depository institution borrowers. Looking at the borrowers' ages reflected in the CCP data, Table 1, Column 4, we find differences in account holdings reflecting the business practices of each lender. For example, we find that depository institutions tend to lend to slightly older and more established borrowers. The median age of a borrower taking a personal loan from a depository institution is 48, 2 years older than that of a finance company borrower. Moreover, within the finance company sector, we find that the sales finance company borrower median age is notably lower than that of a personal loan company borrower. This may be a reflection of the nature of goods financed by sales finance companies, such as appliances, acquisitions more consistent with younger borrower habits. In contrast, personal loan company accounts are less likely to be held by younger consumers, as older borrowers are more likely to use personal loans from traditional finance companies to refinance debt. The median borrower age on a fintech-issued personal loan account is 45. Data from the two largest fintech lenders, Lending Club and Prosper, show that a stable share of their loan issuance, about 70%, is for debt consolidation purposes. 14. Finally, looking at personal loan holdings by product type and borrower risk profile, Table 2, we note that about 1/4 of total outstanding balances are secured, about 60% have fixed interest rates, and 40% are held by nonprime borrowers, those with Equifax risk scores lower than 720. 15. Although in terms of account holdings, depository institutions and finance companies tend to hold similar shares of secured, unsecured, and other loans, their holdings of unsecured and other loan balances differ. Depository institutions hold more other loan balances, while finance companies hold larger unsecured loan balances. Moreover, we note differences in fixed-rate loan holdings, with depository institutions holding larger shares of fixed-rate loans and balances in comparison to finance companies, about 65% relative to a little over 40%. Exposures to non-prime borrowers also vary by sector, with finance companies leading the credit offerings for such borrowers. Nearly all fintech loans and balances are unsecured and about 3/4 have fixed rates. More than half of fintech loan balances are loans extended to non-prime borrowers. 4. The supply of personal loans. In order to better understand the supply landscape for personal loans, we turn to Mintel Comparamedia data, Mintel from now on, a data set consisting of monthly acquisition offers, solicitations, for personal loans. As the solicitations are credit offers, they are a measure of credit supply. 16. The data represent monthly campaign-level mail volume sent to consumers. Mintel randomly selects roughly 4,000 consumers from a pool of 1 million consumers that Mintel purchased from a large survey service provider. 17. The company records all the offer details in its databases, thus offering insights into the rich supply offer landscape. 18. Finally, Mintel applies weights to about 2,500 consumers participating in the survey to represent the entire U.S. adult population. Importantly for our analysis of the supply landscape, the data enable us to observe the name of the company sending the offer and the product type, which, in turn, enables us to categorize the offers by lender type. 19. Mintel data estimates show that in 2022 approximately 1.5 billion personal loan acquisition offers were sent to consumers. 20. Offers for unsecured loans dominate the personal loan supply, with only 7% of offers being for secured loans. Finance companies and fintech lenders in partnership with specialist banks currently dominate the personal loan supply landscape with 34% and 33% of mail offer solicitations, respectively. The remainder of offers are issued by banks other than those involved in partnerships, 16%, fintech lenders without the participation of banks, 7%, banks that are typically involved in partnerships making independent offers, 6%, other financial institutions, 3%, payday lenders making installment loan offers, 2%, and credit unions, less than 1%. 21. The 2022 personal loan supply landscape was not much different from that of the past decade. Looking more closely at the fintech bank partnership sector over the past 10 years, we observe the notable participation of the market leaders, WebBank and Cross River Bank, alongside other participants such as First Bank of Delaware, First Electronic Bank, Farmers Merchant Bank, Mid-America Bank and Trust Company, County Bank of Rehoboth Beach, Republic Bank, the Brand Banking Company, FinWise Bank, Goldman Sachs Bank USA, First Bank and Trust, and Capital Community Bank. When examining the partnership structure, we note the dominance of WebBank, 55% of offerings, and Cross River Bank, 36% of offerings. The fintech company presence in partnership structures is less concentrated than that of partner banks. Before becoming a bank, Lending Club had the largest share of offerings, 37% of offerings, closely followed by Best Egg, 25% of offerings, and Prosper, 18% of offerings. Upstart and Upgrade have much smaller shares of offerings, 9% and 3% of offerings, respectively. Next, regarding the finance company sector over the analyzed period, it is important to note the robustness of the supply of credit provided by this sector over the past decade, which includes the pandemic years, Figure 2. While the supply of credit from all the other sectors reflected in the data shrank at the onset of the pandemic, the supply of credit from finance companies remained virtually unchanged. This could be explained by finance companies' risk-inclined traditional business model. OneMain, Springleaf leads both the unsecured and secured mail offer solicitation campaign volume, followed by Big Picture Loans and World Finance Corporation. 22. Also of note, as mentioned in the previous section, finance companies concentrate their credit supply in states that allow them to be profitable. In Figure 3, we show the mail volume concentration over the period. Banks, whether traditional or specialist, those typically engaged in partnerships with fintech lenders, made about the same number of solicitations over the period. Among them, Discover Bank is the leader among traditional banks, and Goldman Sachs Bank USA dominates the mail volume solicitations sent by specialist banks without a fintech partner. Rise, Payoff Inc., and Social Finance, Inc. lead the mail volume solicitations from fintech lenders without a bank partner. Finally, as our data allows us to observe the participation of payday lenders to the personal loan space, we note that Check and Go is the market leader in terms of payday mail offer solicitation campaigns for personal loans, with 31% of mail volume solicitations. Castle Payday and Arrowhead Advance each offered about 10% of the mail volume solicitations mailed over the period, followed by Advance America and Cash Store with 8% of solicitations each. 5. Conclusion. In this paper, we provided an overview of the personal loan sector in the U.S. by combining data sources to allow for a deeper look into an otherwise opaque sector. We started by briefly reviewing the regulatory environment for personal lending, which is governed by state interest rate ceilings and banks' ability to export their home state interest rate. We examined the stock of personal loans with the help of a newly released CCP data set, and we were able to examine the supply landscape with the help of Mintel data. Our data revealed that, in 2022, there were approximately 1.5 billion mail acquisition offers sent to borrowers and that 31 million consumers owed about $356 billion in personal loan debt, representing about 10% of total non-revolving consumer credit. The average monthly payment on a personal loan is about $202. About 1/4 of loans are secured, and the majority are fixed rate. Exposures to non-prime holdings are concentrated within the finance company sector. In a subsequent note, we will examine in depth personal loans belonging to the fintech sector.